An area that tends to cause some confusion for taxpayers is related to individual estimated income tax payment requirements. Estimated taxes are used to pay tax on income that is not subject to withholding, or if the withholding is not enough to cover tax on that income. An independent contractor receiving a 1099 is an example of someone receiving income that is not subject to withholding. The most common payments which are subject to withholding is payroll, where an employer withholds from the employee's pay and submits to the IRS on behalf of the employee. In general, estimated taxes are required to be paid evenly throughout the year on a quarterly basis if the income is earned evenly throughout the year. These payments are due April 15th, June 15th, September 15th, and January 15th for a calendar year taxpayer. If the income is not earned evenly throughout the year, the estimated tax due dates can be adjusted to reflect the actual receipt of income. For example, if a cash basis independent contractor earned no income during the first 6 months of the year and then received, for example, $50,000 in the month of July and nothing else the rest of the year, that income would be considered earned during the third quarter, and therefore the September 15th estimated payment would consist of 75% of the estimated annual tax requirement. The remaining 25% in that example would be due January 15th. In that example, there would have been no obligation for an estimated tax payment on April 15th or June 15th, since no income was earned during that period. If payments are not made on a timely basis, the taxpayer is subject to an underpayment of estimated tax penalty, which is calculated on Form 2210, which is part of the individual income tax return. IRS will not assess a penalty during the year, since they do not know what the taxpayer's obligation for estimated tax is until such time as a tax return is filed. There are safe harbor levels of estimated tax that will allow a taxpayer to avoid an underpayment penalty. First one is 90% of the tax on the individual's tax return for the current year, or 100% of the tax shown on the prior year return. 110% in the case of a married filing joint return or single with adjusted gross income in excess of $150,000, or in excess of $75,000 for married filing separately. Now, in January of 2019, IRS came out with a ruling that they would not charge a penalty as long as the taxpayer hit 85% of their tax payments throughout the year, where in a normal year it was the 90% and the 100% that I just mentioned. That is, at this point, for 2018 tax returns only.